Could a single Supreme Court ruling wipe out billions in government revenue and shake gold, bonds, and the dollar at the same time? That's the crossroad at which we are right now. Hey all, welcome to ShareTreck, where science meets investments, and I'm your host Raj. Friends, today we are diving into US Treasury debt management, the surge in tariff revenues, the Supreme Court's challenge to Trump-era tariffs, and what all this means for financial markets, gold prices, and Federal Reserve policy. Stick with me because by the end you will see how these moving parts connect and why investors are worried that Washington may be losing control. Let's start with debt buybacks and Treasury bill issuance. In 2025, the US Treasury restarted its buyback program to smooth out the debt maturities and boost market liquidity. In May, it pulled off a $20 billion buyback, the biggest since early 2000s. And it's now running weekly operations of $2 to $4 billion in 20 to 30-year bonds, which means that it's raising smaller duration treasuries and using that money to buy $2 to $4 billion worth of 20 and 30-year bonds and extinguish them. At the same time, Treasury is issuing a heavy volume of short-term T-bills with a clear target. They want to keep short-term Treasury bills to around 20% of all marketable debt. The 20% acts like a shock absorber for seasonal borrowing spikes. Now, here is why this matters. These aren't simple swaps. Buybacks and bill issuance are separate levers in a bigger strategy to keep borrowing costs manageable without letting debt structure tilt too far, short or long. And remember, banks and primary dealers join these actions voluntarily. They are not forced buyers. That's the important context for how real demand gets tested in the market. And even if the banks buy, they are buying on behalf of their customers. They don't have to forcibly buy and keep it in their books. Friends, if you're finding this breakdown helpful, please hit the like button. It really helps other investors discover this content. That said, does it help against the debt ceiling is the big question. Now let's turn to tariffs, because this is where fiscal policies and market mechanisms collide. Since 2025, Trump administration tariffs have been pulling in tens of billions of dollars every month. Some people assume this cash is being earmarked for buybacks or debt paydown. No. In reality, it isn't. Tariff revenue just flows into the general federal budget. But here's the catch. With another debt ceiling standoff coming, this extra revenue gives Treasury a little more breathing room. Think of it like plugging leaks in a boat. It doesn't fix the bigger problem, but it slows down the water from rushing in. So tariffs don't fund buybacks directly, but they do ease near-term borrowing needs, and that could buy Washington a few months of political maneuvering before the debt ceiling drama hits full swing. Now, let us take a look at the Supreme Court case. Legal and economic stakes are high. Here's the real flashpoint. The US Supreme Court has fast-tracked a case in November on whether President Trump had the constitutional authority to impose broad tariffs using emergency powers. Lower courts have already ruled against parts of these tariffs, arguing Congress, not the White House, holds the tariff power. For now, tariffs remain in place, but if the court strikes them down, Washington could lose $40 to $50 billion monthly revenue stream overnight. Creating a revenue stream is really euphoric, but losing a revenue stream is very painful. This would immediately widen the budget gap, forcing more borrowing just as markets are questioning US debt sustainability. This isn't just a trade case, it's a test of separation of powers, fiscal stability, and the credibility of US governance itself. In a moment, I'll show you why gold and treasury markets are already trading as if Washington has lost control. Gold prices are surging, fueled by global central banks shifting out of US treasuries and into hard assets. That's a diversification away from the dollar and an unmistakable hedge against the US fiscal risk. Meanwhile, the US dollar index is showing weakness. Investors are starting to question the dollar's role as a safe haven. Bond markets are also watching. If credibility falters, so-called bond vigilantes could demand higher yields, essentially punishing Washington with tighter borrowing conditions. And here is where the Fed comes in. With inflation not fully under control, the Fed may still consider rate cuts in September, not as an economic boost, but as a way of keeping markets from seizing up. This is where the dots connect. golds, bond, and the dollar are all signaling fading trust in US fiscal and monetary management. What it all means is that the Supreme Court's tariff verdicts will shape not only the trade law, but also the fiscal math and political leverage in Washington. Treasuries buybacks and T-bill issuance show an attempt to balance debt structure, but they can't insulate markets in if tariff revenues collapse. And even the T-bill action for extinguishing long-term debt, it's a drop in the bucket when you look at the multi-trillion dollar debt that US is holding. And markets themselves are becoming active referees, moving gold higher, dollar lower, and yields upward as they price in doubts about the US credibility. Now, so the question investors have to ask is this: if bond markets really do turn into fiscal watchdogs, does the Fed have the tools or the will to stop them? That's the uncertainty hanging over September, and it's why I'll be tracking this story closely for you here on ShareTreck. Friends, thanks for watching this video. If you have not yet subscribed, can you please subscribe and help the channel grow? And if you like more contents like this, please mention in the comment section as well as press a like button. That will send me the message. Friends, this brings me to an end of this video. Thanks and have a great day. Bye for now.